Here is something that almost no financial channel will say directly to you. The single greatest transfer of wealth in American history is happening right now. Not in 10 years. Not after the next election cycle. Right now, in the background of ordinary life, while most people are busy managing their day-to-day, a window is open that does not stay open. And the people who are least positioned to see it, not because of intelligence, not because of access, but because of how the financial system was designed and who it was designed for, are women. That's the first thing. Here's the second. Women in the United States will outlive their male counterparts by an average of 5 to 6 years, which means they will spend more years in retirement, spend more on health care in those years, and need a larger retirement cushion than virtually any financial plan built around the average American household is actually accounting for. Those two things together, the closing wealth window and the longer financial horizon, create a gap. And that gap is not an accident. It was built, and understanding how it was built is the first step to getting out of it. What I'm going to walk through today is not a list of investment tips. It's a structural analysis. A map of where the wealth is moving, why most people miss it, and what the women who are quietly positioning themselves correctly right now are actually doing differently. Let's start with the mainstream narrative. Because the mainstream narrative about building wealth in America right now is both partially true and strategically incomplete. The mainstream version goes something like this. The economy is uncertain. Inflation has been difficult. Interest rates have been elevated. The stock market is volatile. And the sensible thing to do in uncertain times is be cautious, stay liquid, and wait for clarity before making significant financial moves. That narrative is everywhere. And it sounds reasonable. It feels prudent. Here's what it's actually doing. It's keeping retail investors on the sidelines during one of the most significant asset repricing cycles in recent decades. While retail investors wait for clarity, institutional money is not waiting. It is moving. It is accumulating. It is positioning for a recovery phase that historically follows exactly the kind of dislocation we've been living through. This is not a conspiracy. It's a structural feature of how markets work. Uncertainty creates pricing inefficiencies. Institutional investors are designed to exploit those inefficiencies. Retail investors are almost always told to wait until the inefficiency has already been corrected, which is precisely when the opportunity no longer exists. And here's the dimension that mainstream financial media consistently fails to address. Women are disproportionately represented in the retail investor category. Not because women are less sophisticated, the data actually suggests women are more consistent, less reactive, and generate better long-term returns than male counterparts in comparable positions. But because the entire architecture of wealth management, financial advising, and investment media has been built around a male default for most of its history. The language is different. The assumptions are different. The risk framing is different. And the result is a measurable gap between what women earn, what women save, and what women ultimately build over a financial lifetime. Understanding that gap is not about victimhood. It's about strategy. Because once you see the architecture, you can navigate it differently. Let's talk about the window itself, because this requires explanation. Wealth windows are not random. They follow patterns. And the pattern we are currently inside of is one that financial historians have identified repeatedly following periods of significant economic disruption. Here's what the pattern looks like. A major disruption occurs: a financial crisis, a pandemic, a rapid inflation cycle, a structural shift in interest rates. Asset prices reprice significantly, often quickly and chaotically. The disruption creates fear. Fear creates inaction in most people. Inaction means assets sit available at prices they won't maintain once the fear subsides. Then the recovery begins, slowly at first, then with increasing momentum. And the people who accumulated during the fear phase see their positions appreciate significantly as the recovery plays out. This is not investing genius. This is pattern recognition. And the window is the period between the fear phase and the recovery phase when the opportunity is real but not yet obvious to everyone. That window does not stay open. It closes as the recovery becomes visible, as confidence returns, as the obvious opportunity becomes priced in. By the time it feels safe, by the time the mainstream narrative shifts from caution to optimism, the best of the opportunity is already behind you. We are in that window right now, and the decisions made in this specific period will have a disproportionate impact on financial outcomes for the decade that follows. The wealth doesn't disappear, it transfers. To the people who understood the pattern when most people didn't. Now let's get specific about what's actually driving the window. Because it's not a single factor, it's a convergence of structural forces moving simultaneously. The first is the great wealth transfer. Somewhere between $70 and $80 trillion in wealth held by the baby boomer generation is in the process of transferring to younger generations. This is not speculative. It is a demographic inevitability. The oldest cohort of the wealthiest generation in American history is aging out of asset ownership. That wealth has to go somewhere. Women are statistically positioned to receive a significant portion of this transfer through inheritance and through the increasing concentration of women in higher-income professional roles. But receiving a transfer and strategically deploying it are completely different things. Without a clear understanding of where the opportunities are, the transfer gets absorbed into lifestyle rather than compounded into wealth. The second force is the interest rate cycle. Elevated rates over the past few years have repriced large categories of assets, particularly real estate and growth-oriented equities. When rates come down, and rate cycles have always been cyclical, the buying power of financing returns to the market. Demand increases. Prices adjust upward. The people who owned assets before that demand surge benefit from the appreciation. This requires patience. It requires capital deployed before the recovery becomes obvious. And it requires the kind of long-view thinking that financial media consistently underestimates in women investors. Here's the piece that most financial content targeting women gets completely wrong. Most content aimed at women investors focuses on the micro: budgeting, saving habits, emergency funds, debt payoff. All genuinely important, but all the financial equivalent of rearranging furniture while the larger architectural decisions about the house go unaddressed. Macro positioning is where real wealth is built or lost. And that conversation is one women have historically been excluded from. Not because they couldn't handle it, because the people running that conversation never built the table with them in mind. The institutional investor right now is not focused on cutting the grocery budget. They are asking which asset classes will outperform in the recovery phase, which sectors benefit from rate normalization, where the structural growth is, and how to capture it before the trade becomes crowded. Those are the right questions. And they are questions any financially aware person can orient their thinking around. The strategy doesn't require institutional scale. It requires the institutional perspective applied to personal financial decisions. The woman who understands that real assets outperform cash during recovery cycles doesn't need $1 million to act on that understanding. She needs to look at her current allocation and ask whether it reflects that reality or whether it reflects the cautious, wait-and-see narrative she's been surrounded with. Let's talk about risk, because this is where the misframing has been most damaging. Women investors are routinely described as more risk-averse than men, and that framing is used to justify recommending lower-returning, more conservative positions. Bonds over equities, cash over real assets, preservation over growth. Here's what the research actually shows. Women are not more risk-averse. Women are more risk-aware. There is a meaningful difference, and conflating the two has cost female investors real money over the long term. A risk-averse investor avoids risk regardless of the return offered. A risk-aware investor evaluates the actual risk-reward relationship and makes a calibrated decision. Women demonstrate the latter. They take fewer impulsive positions. They trade less frequently. They hold longer. They experience less emotional reactivity to short-term volatility. Those are not the behaviors of someone afraid of risk. Those are the behaviors of someone taking risk intelligently. and they produce better outcomes than the aggressive, high-turnover approach that gets labeled sophisticated when men do it. But when women internalize the risk-averse story, when they accept that they need to be protected from volatility, they accept a lower trajectory, products with lower return potential, timelines that don't align with their actual financial lifespan, and that lifespan is 5 to 6 years longer than the models assume. The conservative portfolio recommended for a couple in their mid-50s may be appropriate for the male partner's horizon. It may be genuinely insufficient for the female partners. This is not an abstraction. It is a structural mismatch that, uncorrected, means women run a meaningfully higher risk of outliving their money. Now let's address the psychological dimension, because the structural analysis is only useful if you can actually act on it. The most common barrier the one financial psychologists identify most consistently is not fear. It's deference. Deference is the pattern of waiting for someone else to validate the decision before acting, waiting for a partner to agree, waiting for an advisor to confirm, waiting for a friend who seems more financially confident to go first, waiting for the feeling of certainty that, in investing, almost never arrives. Deference is not irrational. It emerged from environments where women's financial judgment was systematically discounted by institutions, by advisors, by a culture that communicated for a very long time that financial decision-making was not their domain. But the cost is concrete. It shows up in delayed market entry, in assets sitting in cash for months while waiting for confirmation, in portfolio allocations that reflect someone else's risk tolerance rather than a clear-eyed assessment of your own situation. The antidote to deference is not confidence, it's competence. Competence built through engagement, through understanding the mechanics well enough that the decision feels like analysis rather than guesswork. The woman who understands the macro context, who understands the fee structure, who understands the behavioral patterns that erode returns, she is not waiting for permission to make financial decisions. She's already making them. Here's something that deserves to be said without the hedging that financial content usually wraps around it. The financial system was not built for you. It was built around assumptions about career continuity that don't match the reality of most women's working lives, around household models that center male income and treat female income as supplementary, around risk profiles that underestimate women's sophistication, around retirement timelines that don't account for longer female lifespans. None of that means the system can't be used to your advantage. It absolutely can. But it requires using it deliberately with an understanding of where the design assumptions don't match your reality, so you can correct for them. The correction is not complicated. It looks like funding your own retirement account independently of your household strategy, because your timeline is longer. It looks like understanding the fee structure of every financial product you hold. It looks like making equity allocation decisions based on your actual 20 to 30-year horizon rather than the volatility of the current moment. It looks like treating your career as a financial asset and investing in it with the same intentionality you'd bring to any other investment decision. It looks like having this conversation not with an advisor who may not understand your specific situation, not with a partner whose interests may not be perfectly aligned with your own, but with yourself. Clearly and honestly, about where you are and where you intend to be. That conversation is the foundation. Everything else is mechanics. So here is where everything lands. The window to build wealth is closing not permanently, but for this specific phase of the cycle. The wealth transfer, the rate normalization, the asset repricing that follows periods of disruption, these are time-sensitive dynamics. The accumulation opportunity they create is real, but it does not wait for retail investors to feel comfortable enough to act. Women are disproportionately impacted by this window, positioned in the cautious wait-and-see camp that financial media has encouraged. With a longer financial horizon, that means the cost of missing it compounds over more years than any standard plan accounts for. The tools exist: the retirement account structures, the equity market access, the low-cost index funds. These are genuinely powerful instruments available right now to anyone who chooses to use them. The fee structures and product design assumptions are obstacles, but navigable ones once you see them clearly. The behavioral patterns deference, the wait for certainty reflex, The tendency to treat financial decisions as someone else's domain, these are the real barriers. The moment they are recognized as adaptive responses to an environment that wasn't built for you, rather than accurate signals about your own capability, they lose most of their power. The one concrete shift that applies regardless of where you currently are: look at your allocation and ask one honest question. Does this reflect where I want to be in 20 years? Or does it reflect what I was told to do when someone else decided how cautious I was supposed to be? If the answer is the latter, that is where the work begins. And the question worth sitting with, the one that requires your specific numbers to answer honestly, is this: if you designed your financial position from scratch today, with full knowledge of your actual time horizon, your actual risk tolerance, and the actual macro environment we are in right now, would it look anything like what you currently have?